Hello, everyone, and welcome back to What Changes. I am your host, May. Today, we are not just looking at a chart, we are looking at a financial event that could define your portfolio for the rest of the decade. We are talking about silver. Right now, as we speak, silver is sitting at a critical price point. It is trading right around that $77 mark. But here is the reality of the situation. This price of $77 is temporary. It is merely a pause. The next 60 days are going to determine the future trajectory of this metal, and the divergence in potential outcomes is massive. We are looking at two very distinct paths. Path number one takes us to $150. Path number two takes us down to $50. Notice that I did not say 80 and I did not say 90. We are talking about life-changing gains or devastating losses. The data we have in front of us today reveals exactly which of these scenarios is more likely to play out. And more importantly, it identifies the specific catalysts that will trigger the move. In this deep dive, we are going to walk through both scenarios, the bull case and the bear case, with zero hype. We are going to look at real data, real support and resistance levels, and real market catalysts. Because at $77, silver is at an absolute inflection point. Silver has already crashed from $121 down to $63 in just 4 days, a 48% collapse. It rebounded to 86, pulled back to 77, and is now consolidating. It is finding its equilibrium. It is building energy. The question everyone is asking is simple. What happens next? Does silver break out to new highs, or does it collapse to new lows? The answer, as we will see, is not random. It is entirely data-driven. Before we can even attempt to predict where silver is going in the future, we have to deeply understand where it is right now. We need to understand the technical, structural, and fundamental ground we are standing on. As of early February 2026, silver is trading in a tight consolidation zone around $77. This follows that massive volatility we just discussed. Right now, the price action is compressing. It is building a base. It is testing the resolve of both the buyers and the sellers. Let's look at the floor first. Support is currently established between $70 and $75. This is a crucial range. Why? Because the data from MCX Silver Futures and COMEX Futures shows high volume trading right here. Every single time silver dips below $72, buyers emerge. These aren't just speculators. We are seeing industrial users locking in supply, physical buyers accumulating bars, and institutions building positions. They see value at $72, and they step in to defend that price. Now, look at the ceiling. Resistance is sitting between $85 and $95. This is where the sellers have consistently taken their profits. We saw silver hit 86 and pull back immediately. We saw prior attempts at 92 fail. At 95, historical profit-taking zones were established. This is the ceiling for now. So here is the setup you need to visualize. Silver is trapped in a range between $70 and $95. The next major move, the move that changes everything, will happen when silver breaks one of these levels. If silver breaks above $95 and holds that level for 2 consecutive days, the rally resumes. The targets then become 110, then 130, and finally $150. However, if silver breaks below $70 and closes below 65, the crash continues. The targets on the downside are 55, then 50, and potentially even lower. These are two completely different outcomes, driven by completely different data sets. Let's explore the data for the upside first. Let me walk you through the scenario where silver climbs to $150. I am not presenting this because I want it to happen, but because the data supports it as a very real possibility. There are 5 specific catalysts driving this thesis. Catalyst 1. Industrial demand acceleration. We are witnessing a structural shift in how silver is consumed. Let's talk about solar power. Solar photovoltaic panels are projected to consume 230 million ounces of silver in 2026 alone. To put that number in perspective, that is 20% of global silver mine production just for solar panels. This demand is growing at 15 to 20% annually. It is happening in China, it is happening in India, it is happening in Europe, and the United States solar build-out is accelerating. This is not a trend that is slowing down. Then you have electric vehicles. EV production is forecast at 14 to 15 million units in 2026. Each hybrid electric vehicle uses between 50 and 80 grams of silver. That equates to another 70 to 75 million ounces of silver demand. On top of that, we have 5G infrastructure and AI data centers. These technologies require silver for its conductivity. Between grid upgrades, charging stations, and server farms, you are adding another 15 to 20 million ounces of demand. When you add all of this up, the total industrial demand for 2026 is forecast at 1.1 billion ounces. This is near record levels. And here is the most important part. This demand is inelastic. That means industrial users cannot substitute silver for something else. They need silver. They will pay whatever price is necessary to get it. Catalyst 2. The supply deficit. While demand is skyrocketing, supply is stagnant. Global silver mine production is approximately 900 million ounces per year. Here is the problem. 70% of that is byproduct production. That means silver is mined as a secondary product from copper, zinc, and lead mines. This is a critical nuance. If copper prices drop, or if those mines reduce output for any reason, silver production drops automatically. Silver production cannot simply scale up quickly to meet demand. So, do the math with me. Industrial demand is at 1.1 billion ounces. Mine production is at 900 million ounces. That is a structural deficit of 200 million ounces. This deficit has existed every year for the past 3 years, and it is widening. Usually, deficits are filled by recycling, government stockpile sales, or ETF outflows. But those sources are finite. In fact, in 2025, we saw ETF inflows of 15 to 20 million ounces, not outflows. That tightens the supply even further. We have rising demand, flat production, and a structural deficit of 200 million ounces per year. That is incredibly bullish. Catalyst 3. Dollar weakness. Silver is priced in US dollars. When the dollar weakens, silver becomes cheaper for foreign buyers, and foreign capital flows into the metal. Right now, the US dollar index is under pressure. We have widening fiscal deficits, accommodative Federal Reserve policy, and sticky inflation. If the dollar continues to weaken, silver gets mechanical buying pressure. This isn't even about fundamentals, it is purely currency effects. A 10% drop in the dollar could push silver up 20% just from foreign buying. If the Fed signals dovish policy or cuts rates, the dollar drops further, and precious metals, both gold and silver, will rally together. Catalyst 4. Gold-silver ratio compression. The gold-to-silver ratio is currently hovering between 70 and 82. This means 1 ounce of gold is worth roughly 70 to 82 ounces of silver. Historically, during precious metals bull markets, this ratio drops significantly, often to between 40 and 60. Let's play out the math. If the ratio drops to 60 and gold stays at $2,700, silver goes to $45. But if gold rallies to $3,000, which is a very real possibility, and the ratio drops to 60, silver goes to $50. If we see a true mania phase where the ratio drops to 40, which it often does in late-stage bull markets, and gold hits $3,000, silver hits $75. If gold goes to $4,000 and the ratio is 40, silver is at $100. We have historical precedent for this. In 2011, silver hit $49 while gold was at $1,800. The ratio was roughly 36. If we see similar dynamics today, silver at $100 plus is absolutely realistic. Catalyst 5. Short squeeze and momentum. Right now, with silver consolidating around $77, open interest remains elevated. The shorts are still in the market. If silver breaks above $95, those shorts will panic. They will be forced to cover their positions, and that buying pressure will accelerate the move upward. Technical analysts forecast that a sustained move above $92 triggers a price discovery phase. This means silver enters new territory with no overhead resistance. Momentum traders will pile in. The targets become 110, then 130. Some bullish analysts even forecast silver reaching $149 by the end of 2026, based on these factors. So, the bull case summary is clear. Industrial demand is rising. We have a structural supply deficit. The dollar is weakening, the gold-silver ratio is compressing, and there is massive short squeeze potential. The targets are $100 to $150 by mid to late 2026. Now, we need to be objective. We need to look at the other side of the coin. Let me walk you through the scenario where silver drops to $50. This is not fear-mongering. This is risk analysis, because the data also supports a bearish scenario if certain conditions are met. Catalyst 1. Strong dollar and rising rates. If the Federal Reserve signals more aggressive tightening to fight inflation, the dollar will strengthen. When the dollar strengthens, silver gets sold. Foreign buyers disappear because the metal becomes too expensive in their local currencies, and dollar-denominated assets drop in value. There is a real risk that inflation stays elevated, and the Fed is forced to hike rates further. If that happens, precious metals will sell off. Silver, having higher volatility than gold, will drop faster. A 10% rally in the dollar could push silver down 20 to 25%, taking it from $77 down to around $60. If the dollar rallies by 15%, silver could test $50 or below. This is a real risk that cannot be ignored. Catalyst 2. Profit-taking and speculative unwinding. We cannot forget that silver rallied from $40 in November to $121 in January. That is a 200% gain in just 3 months. After a parabolic move like that, massive profit-taking is inevitable. We already saw a glimpse of this on January 31st, when silver crashed from $121 to $74 in a single day. That was profit-taking, forcing liquidations and margin calls. That selling pressure could easily resume if silver fails to hold its current support levels. If silver breaks $70 and closes below $65, technical traders will sell. Stop losses will trigger. The momentum will reverse. The next support level is $55 to $60. If that breaks, $50 is in play. Some bearish forecasts see a pullback to the $60 to $65 range as a healthy correction, but others see a risk of a deeper drop to $50 if macroeconomic conditions deteriorate. Catalyst 3. Industrial demand slowdown. While the long-term forecast for industrial demand is strong, there is a risk of a short-term slowdown. If global economic growth decelerates, industrial activity slows. Demand for electronics drops. EV production stalls. Solar installations pause. China is a major driver of silver demand. If China's economy weakens further, silver demand takes a direct hit. The same applies to Europe and emerging markets. The base case is that industrial demand stays strong, but the risk case is that demand softens. If demand softens while supply stays flat, the deficit narrows, and silver loses its fundamental support. Catalyst 4. Technical breakdown. From a technical perspective, silver is in a precarious position. Medium-term trends are neutral to bearish. The 50-day moving average is being tested. If silver breaks below the 50-day and the 200-day moving averages, the trend reverses from bullish to bearish. If that happens, algorithmic traders will sell automatically. Institutional money managers will reduce their positions to manage risk. Retail investors will panic. Technical analysis suggests that if silver fails to hold $72 to $73, the next move is down. Target 60, then 55, then 50. Catalyst 5. Historical precedent. We have seen this movie before. In 2011, silver rallied from $18 to $49 and then crashed to $26 in just 3 months, a 47% drop. It then ranged between $26 and $30 for years, and never reclaimed $49 until 2025. If the same pattern repeats, silver could crash from $121 down to $60, base at $60 to $70 for months or years, and not reclaim $100 for a long time. The bearish argument here is that this rally was speculative, driven by retail frenzy and leverage. When that leverage unwinds, the party is over, and silver enters a multi-year consolidation. So, the bear case summary is this: a strong dollar, profit-taking, industrial demand risk, technical breakdown, and historical precedent could drive targets to $50 to $65 if support fails. So we have 2 scenarios: bull case to 150, bear case to 50. Which one is more likely? Let's look at what the data actually reveals. First, look at the support. It is holding. Silver has tested $70 to $75 multiple times over the past week. Every single time buyers stepped in. Silver is currently at 77, above that support zone. This is not random. This is institutional accumulation, industrial hedging, and smart money positioning. If support was weak, silver would have broken 65 by now. It has not. That tells you the demand is real. Second, industrial demand is structural, not cyclical. Solar demand is not going away. EV production is not stopping. 5G build-out is not pausing. These are multi-year megatrends, and they all require silver. Even if we get short-term economic weakness, industrial demand for silver stays elevated. Third, the supply deficit is a mathematical fact. 200 million ounces per year. That is not a projection. That is reality. With mine production inelastic, the deficit continues. This means that every year, above-ground stockpiles shrink, creating a squeeze. Fourth, the dollar is under long-term pressure. Yes, it could rally in the short term, but long-term US fiscal deficits are unsustainable. The Fed is trapped between inflation and recession. That is bearish for the dollar and bullish for hard assets like silver. Fifth, the gold-silver ratio is elevated at 70 to 80. Silver is cheap relative to gold. Historically, when the ratio is this high, silver outperforms. So, what does the data favor? The data favors the bull case. Not because of hope, but because the weight of evidence leans bullish. That does not mean the bear case is impossible. If the Fed shocks the market, or if industrial demand collapses, silver could drop to 50. But those are low probability events. The base case, based on current data, is that silver holds above 70, consolidates for another week or two, breaks above 85, retests 95, and then resumes the rally. The targets remain 110, then 130, then potentially 150 by mid to late 2026. Knowing the data is one thing, knowing how to act on it is another. Here is the action plan for both scenarios. You need to watch the $70 level. That is your line in the sand. Scenario A, the bullish breakout. If silver breaks above $85 and holds that level for 2 days, that is your bullish confirmation. At that point, you enter long positions, whether that is physical silver, PSLV, or miners. Your stop loss is at $79. Your first target is 110. The second target is 130. The third target is 150. If you are already holding physical silver or PSLV, do nothing. Let the position run. The fundamentals support higher prices. Scenario B, the bearish breakdown. If silver breaks $70 and closes below 65, the thesis changes. At that point, the bear case becomes the base case. This is the bearish confirmation. You must exit speculative positions immediately. Tighten stop losses on your core holdings. Wait for the next support level at $55 to $60 before you even think about re-entering. If you are currently on the sidelines with cash, wait for the breakout. Wait for silver to either break above 85 or below 65. Do not chase the current level at 77. Let the market show its hand and then act. And remember, watch the weekly close. Silver's weekly close tells you more than the daily noise. If silver closes above 85 weekly, that is bullish. If it closes below 70, that is bearish. Before we wrap up, we have to talk about the wild cards. These are the scenarios that do not fit neatly into the bull or bear case, but could trigger massive sudden moves. Wildcard 1. COMEX default or delivery failure. If the COMEX cannot deliver physical silver to contract holders, the paper market breaks. Price discovery would move instantly to physical spot markets in Shanghai, London, and Zurich. In this scenario, silver gaps to 100 plus overnight. It is a low probability event, but the impact would be catastrophic for shorts. Wildcard 2. Major mine disruption. If a top 10 silver-producing mine shuts down due to an accident, a strike, or government action, supply tightens instantly and prices spike. We have seen this happen with copper in the past. It could easily happen with silver. Wildcard 3. Central bank buying. If central banks start buying silver alongside gold, demand explodes. Imagine if China, India, or Russia announced strategic silver reserves. The market would reprice immediately. Wildcard 4. Industrial panic. If solar manufacturers or EV producers realize they cannot secure enough silver supply, they will start bidding aggressively. Industrial users do not care about technical chart levels. They care about keeping their factories running. If they panic, they will pay any price to secure metal. All of these wildcards are low probability but high impact. And notably, they all skew bullish, not bearish.
So here is the bottom line. We are at $77. We have two scenarios, 150 or 50. The data favors the bull case, but the bear case is real. The next 60 days decide everything. Watch $70 on the downside, watch $85 on the upside. You are now positioned ahead of the market with the data you need to make the right call. If this deep dive helped you understand the stakes, please subscribe to What Changes. We are tracking this every single day. Let me know in the comments, do you think silver is going to 150 or 50? And why? I want to see what this community thinks. I'm May. Stay safe, watch the levels, and I will see you in the next video.